Okay, so here we go. Spark Space, the Sandy Hook Class 4. I know you've had some classes with Andrew, and we're screen. Hopefully you can see the screen. It certainly says on top of my screen that I'm sharing. I haven't had a homework in for the Sandra Villette question, so I will have to talk through that one when that arises. Right, let's just close the door. That's me turning open a biscuit. Okay, today's the 25th of July, and I've shown you these lists of topics before. This week, I'm happy to take requests, but certainly I've agreed with Andrew that my main things for this week are, oh dear, our funding and financial analysis, which we'll look at today. I'll try and include some exam writing skills, and then tomorrow, no, not tomorrow, on Wednesday, we will look at more exam writing skills using typical questions. I was going to run through the homework task and mark one. I haven't actually received any, as I said a minute ago, so what I will do instead is to try and talk you through things and ask you some questions and see how much thought you might have put into this since Wednesday. So this one was in relation to, let me try and see if I can move the chat box. I don't quite know what that's all about there. You may see something on your screen about some sort of person who wanted to contact me on Skype. I must admit, I've never heard of them. Right, that's far better. Now I've moved the chat box down so I can still see it, and you are welcome to use this to contact me at any time. I won't necessarily respond straight away depending on what I'm doing, but as you know from previous classes, I will come back to the chat box and try and respond. Sandra Villette has found a creative opportunity for Spark Space, and the collaboration would be with a small entrepreneurial organisation where Spark Space would provide the finance and the collaborator would provide the project idea. In the context of the server market in West End, outline how you would recommend she appraises the project. Include how investment appraisal techniques can incorporate risk. So, not an unusual type of question. We've got one of the directors of Sparkspace looking for new opportunities, and I would normally reckon that would be about half of a 45-minute section. So it would be one where you'd plan it for about 5 to 6 minutes, get in plenty of headings, try and get 2 paragraphs per heading, and then keep everything in the context of Sparkspace. Now, in the absence of one to mark in front of you, let me have a look. We have to outline how she should appraise the project. Well, okay. I'm sorry, Vivian, I can't answer you at the moment, whoever you are. That was most unusual. It was the same name that I came across a few minutes ago. My apologies. Right. So, how can she appraise this project? This is someone who is looking at the project. We are effectively going to be carrying the financial risk, aren't we? We would provide the finance, the collaborator would provide the idea. So, imagine that it went wrong. They would walk away very cross with themselves that the idea hadn't worked. We would be very cross with ourselves because we'd done our money. So, what methods might we use to appraise the investment? Let me see my participant list. It's growing and growing and growing. Marvellous. So one method each, please. If you can put them into the chat box. Oh, excellent. So we've had MPV from Ziad. Just in case Ziad sent it privately, so you might not have seen it yourselves. Wow. I've got an... You're right. I hadn't thought of the SFA model. This is suitability. I guess it's the feasibility, acceptability model. Please tell me if I've misinterpreted you. But yes, that would be. And I've managed to put Ziad's name instead of NPV. So. Just to show that I was losing concentration. Yes, suitability, feasibility and acceptability. Yes, from the Johnson & Scholes Whittington. Okay. I will add that to my list. It's certainly within that. Then a lot of the numerical techniques for within the feasibility criterion. Alright, no, that's fine. Any more? Is Ziad my only participant? Are you all going to leave Ziad to do all the work for you? Oh dearie me. Let me check my participant list again. I've got Alan, Anne, Aswathi, Christy, Camille, Kamari, Suchi, and of course Ziad has been doing all the work. Well, IRR from Alan. Good, so we've got IRR coming in. Another good way. Anyone going to suggest payback? Or discounted payback? What about accounting rate of return? And somehow or other I've managed to pull my slide right down. Okay, right, it has gone right up. Okay, so these would be different methods of appraising the project, and hopefully within your recommendation you will have gone through. So we would want move on to the next slide. Copy the slide, duplicate the slide, and I think what I've done is I've taken the top section of the slide, there we go. Let's insert another text box and then move our way. Okay, so now, so you would be looking to assess the so in other words, looking at the benefits and weaknesses and that method is, it's very likely that NPV will, you don't need to change your spellings if the words look alright. I mean, I've got suitability there, but I think we know what it means. Very likely that NPV will be your chosen method. Then, at least I've managed to get a W in method. Then having identified that method, you'd be justifying it. So the justification based on the time value of money and the other key inputs. We talked about garbage in and garbage out before, and so we would want to be sure and when I say accurate as we possibly can be, given the circumstances, we must have accurate forecast values and a accurate discount rate. Okay, now if we are partnering with an entrepreneurial firm, they may be a little bit sloppy in terms of their thoroughness when it comes to appraising prospective ideas. They may jump the gun. Suchi can't hear me. Anybody else? Have I clicked on a button to stop the hearing? I mean, Can't hear you from lots of people. Right, it must be me. Let me see if I've clicked on here. Audio. I've got it on unmute. Let me see what I've got here. Right, slight interruption while I try to investigate. Can hear you but can't see you. Oh, well, hopefully you can see this. Let me make absolutely sure that I'm doing what I want to do. I don't want that to do with. Right, let's see. Audio's on. Can hear you now. Oh. Well, I don't know what I've done. I didn't think I'd done anything. Ziad, you can't see me, but the video stream is slowing the connection too. That's why they now can't hear me. How strange. Right, let me ask the question. Can you go back. Can you see the slides? Can you see the slides? Yes, slides are okay, and the audio too from Anne. Good. Yes, from Alan. Okay. So, can I take it then? And that's why they can. Everybody can see. What about this? The hearing. So I've just put hearing question mark, which I suppose is all very good to those who can hear me. Yes, we can hear you. Yes, can. Clear. Yes. Right. I'm not quite sure what's happened. I told you that I had a strange sort of unknown person try to contact me by Skype, and I shut that down. I wonder if that may have been the issue. So my humblest of apologies, but I'm glad that we're back up and running. Okay, so after that little digression, we resume with incorporating risk. We've got a recognition of risk. We know that we are partnering with a company who is probably less bureaucratic, but also may overlook certain risks and make mistakes because of it. So I've got a question for you, and another chance to use the chat box. Oh, we're going to use the chat box more today than most, I can see. How can you adjust the appraisal of a prospective investment to accommodate risk? What are some of the things that you can do? I'm looking for something very similar to last time. Last time we had NPV, IRR and so on. So discount rates. Alright, so I will expand what Ziad has said, and we'll have a raise the discount rate, thereby incorporating the risk element within the discount. Okay. What are other things that you can think of? Certainty values, where you downgrade your forecasts to certainty values in the any more? We've got something that might or might work. We think it's going to work, perhaps based on a conventional net present value approach. We could look at the standard deviations. And immediately we are recognizing that there is no one single expected cash flow, and we're looking at a range. Okay. So here we are at Spark Space. We're looking at a prospective investment, and we're now incorporating our recognition of the risk that we're going to be suffering, thereby making it harder to have a positive net present value. Okay. Let me then ask you an easy question. I got better responses to the "can you hear me" than I did to the actual subject content. So, what would be the conventional... Okay. Discount rate for activities we normally invest in. So how would we determine the discount rate that we're going to use for those kinds of activities? I'm pretty sure that Ziad's my star student today, but come on, you need to try and compete. The dividend discount model. That wasn't what I had in mind. But I must appreciate that. And CAPM's I don't think CAPM's in our syllabus. Pretty sure that the only discount rate for equity is the dividend valuation, dividend growth model. But what do we use for when we're investing in activities? Well, in the absence of anyone to come along and help Ziad, he's been left on his own. Whack! Weighted average cost of capital. Come as a surprise? We mentioned it in the previous class. It's made up of the cost of equity and the cost of debt. Right, so, oh good, whack and spend, oh good. And I put forward, so, Alan's heard of it, so it comes out to okay. So, you've never heard of it, Ziad? Right, okay. In our class on Wednesday, I highlighted part of the syllabus, which I happen to have repeated today. So here's the little bit of the syllabus, and within the F2 syllabus nowadays, in the OT exams, then the calculation of WACC is very often examined. Constitutes 15% of the F2 syllabus, so it's a big deal. Okay, I scrolled forward to show that, but it's coming up very soon. All right, let's move on and look at funding. Financial resources provided to make a project possible. Yeah, we need funding. We need essentially two types of funding. I've managed to add an extra slide, so let's delete it. Right, we need two types of funding. We need funding that the capital investments, the payment for the non-current assets so that's funding that has to be there, and unless we're looking at very short-term capital investments, we are generally looking at long-term funds. And the other one, we're looking for working capital investment coming from those areas within the statement of financial position, such as inventory, finance. Here we have the servers. I think that inventory finance is probably a big deal. It takes us time to be able to produce the service for our clients. So cash is tied up while that's taking place. If our clients are on credit terms, then we have to finance that. So the trade receivables would also require working capital investment, and fair enough, there may well be a little bit of help that we get from the trade payables, but essentially this needs to be financed. And you may recall from your numerical calculations of capital investment appraisal that we tend to treat the working capital investment as a cash outflow in each year that it's incurred. In some examples, it's a cash outflow in year 0 at the beginning, but in all of them the cash is then assumed to come back in the final year, so we see it as a cash inflow. And its influence over our decision is because of the time value of money and the fact that the year when it comes back the present value is much lower than the year when it is initially paid out. I will then go back to the syllabus that we looked at last week and that I showed a few minutes ago when I was rather anxious that I think only Ziad and Alan had heard of WAC. But certainly today's class we're moving on to funding, and we've got to look at it in the context of Spark Space. We've got to look at the characteristics of different types of long-term debt and equity finance. And we'll look at the markets for raising long-term finance. Interesting in this case, and I have to be honest, I've tracked back over past exams. This hasn't really cropped up in either of the two previous exams this year, and I will show you the time when it did turn up, which was in the November 2015 exam, in a few minutes. But even then it was only one question out of all 5 variants. So the indicative content, right, arrows working good. Characteristics of ordinary and preference shares and different types of long-term debt. So I would say reasonably prescriptive in terms of what you need to know. I think we have to relate it to Spark Space. We're well aware that they carry a huge amount of debt, and that their gearing, based on the approach I have of long-term debt divided by total capital employed, is over 50%. I think anybody who is doing it as a debt over equity would find that it's over 100%. So I think that we have to look at this in the context of Spark Space because of their rather heavily indebtedness. But as we already know, this isn't unique to Spark Space, because BitBunch has a similar sort of capital structure, which means that we're not necessarily dealing with something which is completely out of the ordinary for this industry in this country. Right, we'll have a look at the operation of stock and bond markets, some share and bond issues. I'll talk briefly about the role of advisors, typically merchant banks. Look at the cost of equity, and this is where I took issue, I think, with Ziad, that in our syllabus the cost of equity calculated by other methods apart from the dividend valuation model or the dividend growth model don't actually appear in the CIMA syllabus until the F3 unit. Then we've got post-tax cost of bank borrowings, yield to maturity of bonds. I hadn't done a lot of preparation on that, but I would certainly be happy to look at that if anybody wanted to. And the post-tax cost of convertible bonds, up to and including the conversion and the WAC. Okay, so let's move on to the specifics of Spark Space. I don't seem to be able to see my bottom row. I think this is because this isn't. This is in slideshow. End show. Okay. Right, I can see them properly now. That's better. Continue recording. Good. And we've sort of jumped back, which is a bit of a shame. Right. I've got the Spark Space gearing, which we've looked at before. I will put the Spark Space not that one yet. Accounts on the screen, and I'll enlarge it because I think it's I've got a bit mad with enlarging. I've got 175% basically. Here we can see the statement of financial position, and we can recognise this high value of loans. Here we've got the consolidated statement of profit or loss. And again, we've got the finance costs in here. So what have I done? I've pulled out the gearing ratio. Gearing ratio is 68.6% this year, or 2015, and 70% last year. Again, a very high figure. Very, very difficult for me to make a judgment, because really this industry seems to be a high gearing industry. But we need to be familiar with the issues that this raises. Interest has to be paid before we work out our profit. So it is a commitment, an obligation on the part of Sparkspace to pay out, well, 339 million in oh no, I've got the wrong figure there. Let me point that up. Oh, hello. I can see somebody else's picture. Gentleman wearing glasses. You're looking very smart. Right, let's look at this. So we are committed to paying about a quarter, $250 million in terms of our finance costs each year. Oh, I've lost the picture. What a nice chap it was to see that. And so at that level, then we've got to make sure that we're making the profits that can pay that, or we can be suffering quite badly. On the next slide, I've done two further calculations. One of them is interest cover, which is good. We're getting, we can afford to pay the finance cost over 6 times out of our operating profit. So, however much I could be a little bit nervous with such a high level of gearing, I am reassured that we are generating the profits, and we're generating the profits at a higher rate than we're incurring for having to take out the loans. And then the second one, where we've had a bit of consistency, it seems that the average rate of interest based on the finance cost divided by the loans has stayed steady at 8%. Now, in the UK at the moment, interest rates are quite low, and if you're perceived by the bank to be a low risk, they're very keen to try and lend you money at quite low rates. So I think that's worth making a note of, and saying, well, they're quite happy, and they're making good money, paying 8% on their loans, but it may be. All right, Gavin, welcome. We're on. Well, we're on slide 13 as it happens, but I'll just put a quick welcome to Gavin. You might be thinking, I haven't had Gavin. Why has Gavin got a welcome and not me? Well, a welcome to everybody. Gavin was a bit late. So here we can see the interest cover and the average rate of interest that we are paying. I can't make up my mind, because I don't think I think it may be a deliberate manoeuvre by the examiner. I'm not sure whether Sparkspace is the parent company or the subsidiary. my gut feel, I suppose, is that if the consolidated accounts relate to SparkSpace, then they probably are the parent. But here we are. An extract from the SparkSpace website. So just so that you can see where it's come from. In fact, I think it's on page 4. Yeah. So on page 4 of the here we are. The parent company is the 100% owner of a number of subsidiaries. I thought that SparkSpace were the parent, and then I looked and saw that there weren't any NEDs, non-executive directors, and I then wondered whether they weren't, and that they were a subsidiary of a parent company. We will find out in the unseen on the day. But that then presents a significance for us in terms of raising funds. It may be that the loans that we've got on our statement of financial position actually constitute loans that have been made within the group. So they may not be loans that are from outside of the group. If we, as a consolidated set of accounts, are a subsidiary of another parent company, then we may well find that those loans are from the parent company. Sorry to be vague, but sadly the pre-scene doesn't really give me the clarity that I would want to be giving you. Right, I said that we would have a look at a past task, and here it is. So bear with me, I'll be very quick, just switch to this. We did this last week, but it doesn't do any harm again. You will start your exam and you'll be allowed 3 hours, and you'll come to a page like this, which I would desperately hope, instead of saying candidate name, would actually have your name, and then you would be able to proceed from then onwards. Obviously you're able to use the software, whereas I'm using it in a PDF form, so I'll just click on. But yes, you would click where it says next, you'd move on. In this particular case, and I think I pointed this out, they can vary, and this one has 2 slightly longer tasks and 2 slightly shorter tasks. Well, 2 slightly longer sections and 2 shorter sections. I've already warned you that really when it says number of tasks, it's not really very helpful. I would consider that's rather misleading, that you're looking for questions within the sections. Sometimes they call them tasks, sometimes they call them elements. But as long as you identify them, and then you're able to deal with them. Now, I'll do my best with quite a long email to try to deal with something similar to what we've got, well, what we could have from our pre-scene. Okay, so here we've got Andrew Gawley. He was the Chief Executive, writing to the Financial Manager, who is yourself. And hello, it's not widely known yet, but Colette, one of the other directors, has decided to retire, and she plans to sell her shares in ABC, which is the name of the company. And it's a pity, as I look forward to her blog. Her job was writing a blog for the company. She's a great networker, really interesting, and I've just copied the blog. She did a few days ago and attached it to the email, so it's obviously an indication of the sort of work that she was doing. things are going to get complicated because we are a public company but not a quoted company. So this is quite an important distinction. And in the UK, certainly, there's only a very small proportion of PLCs, public limited companies, that are quoted on the stock market. And that could be either the UK FT London Stock Exchange or any other stock exchange. Some of them on NASDAQ for other reasons. But very, very small proportion. The vast majority of PLCs are not quoted. All shareholders are free to sell their shares at any time without seeking permission from the board or from other shareholders. And again, I'll explain why they've said that. That's just in case there was anybody who was in any doubt. But if you're dealing with a private limited company, not a public company, then the people who own shares in private limited companies have to seek permission from the board or from the other shareholders before they make a sale of their shares, because they are a private limited company. Whereas a public limited company means that the person who wants to sell the shares, so long as they can find somebody who wants to buy them, can sell them to anyone they like. So, repeating the sentence, all shareholders are free to sell their shares at any time without seeking permission, but the actual sale means going out and finding a buyer and agreeing a selling price, because there isn't an observable market price. So, of course, we are in that middle ground. The public limited company that is not quoted, the shareholders are allowed to, but they still have to try and find somebody who's able to agree to buy them at a price that they want to pay. And here this chief executive says that he owns 25% of the shares in issue. Bipin and Colette, the other two founding shareholders, own 12.5% each, so between them they've got 50. We used to own the whole company between us, but we had to bring in some fresh equity to fund expansion. So if we're thinking into the examiner's head, then they may be thinking, well, what we might do with Sparkspace is we might be at that stage where they want to bring in fresh equity to fund an expansion within the company. So we would need to be thinking along those lines. It would be ideal if Bipin and I could buy the shares, but we can't afford to spend that much. She's agreed to take up to a year to try and find a buyer and enable us to replace her on the board. As a courtesy, we've notified the other shareholders of her departure, and they seem quite concerned. I don't know whether it really matters, because we are not a quoted company, and so the share price can't fall. I'm listening now to you all saying, just because we're not quoted doesn't mean that the value can't go up and down. Well said. Well said. So we've got a bit of an error in here that we would want to pick up on. There's my comment, area highlight, and apart from managing to comment, area highlights again. Yes, complete nonsense. Nobody is irreplaceable, and Colette isn't even all that strong on the IT side of things. She tended to deal more with the consultants. My understanding is that an unquoted company like ours, the finance obtained from equity shares is effectively cost-free. Well, do you want to agree with this? Or are you with me in thinking, oh yes, it does cost, so we don't need to be concerned about the shareholders? I think I'm highlighting too soon, but anyway. And I'm a little surprised at the external, so that here we've got something. I'm a little surprised that the external shareholders are concerned about that ABC's solutions may be at risk because of Colette's departure. Ignoring the sale of her shares, the board sees major risks associated with her leaving. What do you think? Okay. So here you've got an email that's, a blog that she's been writing. She'd gone to a dinner and she'd been talking to people, and she's obviously someone who's very good at networking, and so the company's going to miss out on her in that respect. Now, let's switch back, because I think there's tremendous value in looking at past exam questions, but we have to keep in mind that we have to link it to our own area. So, can you spot what the questions are that are being asked? Let's see if I can get a... See if I can open a new file. Then I can turn over the page and I can cover up part of what I've got on my screen. I don't want that. Right, okay, so would you like to say what are the questions? Let me just look at our list of participants. The ad has been tremendous in giving me lots of ideas. 1, 2, 3. Well, a lot of you are being very shy, or I hope it's not that you don't know the answers. You just don't want to put them down or something. But please feel free to. Oh, can I show the task on the screen? Okay, good question. And there's my blank screen so that it covers it off. And let's remove that. Right. So the task, sorry, it's got a little bit of a highlighter on it, but I don't want you to see that. Okay. Right. Right, so one of the questions Alan has spotted is cost of equity free? Any more? No more questions. Okay. Well, there is more questions, but anyway. Anyone for any more? The risk of her departure. Good. All right. So some good contributions, and I think that when I said that there were more, I think Ziad was actually answering Alan's question rather than putting forward a question. Advice on the effect of share price being an unquoted company. Nice. I like that one. Any more? Anybody in the pipeline concerned on unhappy shareholders? Okay. These are what I pulled out. One of them is, do you agree that the finance obtained for equity shares is cost free? And do you agree that keeping the shareholders happy isn't a concern? Advice on the effect on the share price being an unquoted company. Go back just in case. I think there's always something to be said for I think Anne's got a point. I didn't actually pick that in there, but I will add it. Good. Right, and what risks have the external shareholders perceived from Colette's departure? Good. Alright. Let me now show you, rather like I did on Wednesday, I'll show you the examiner's feedback. I know that I had at least one person who said that it was difficult to read it last time because the font is very small. That's a little bit bigger. Ooh, right, I've got it up to 120%. I hope that for most of you is of a readable size. Candidates seem to take two approaches to the cost of equity. They either thought the question was about the costs involved in selling her shares, and whether it would be the company or Colette that would have to bear those costs, or the other approach was to correctly consider the cost of equity in terms of returns. I think that one of my jobs, as far as being your tutor, is to try and help you to extract questions from the unseen material that CIMA presents. I was very pleased with what you've done, and to the extent that I actually added something that Anne had written. So I don't think we would have fallen into that trap. The other approach was to correctly consider the cost of equity in terms of returns. Many candidates, however, argued that it was effectively cost-free, as the payment of a dividend would only be made if the company made a profit, and it wasn't mandatory, unlike having to pay out a fixed rate of interest on a loan. Very few candidates discussed the need of the directors to maximise shareholder wealth, and the examiner was disappointed with that. Okay. Right, so have I got my little Word document again? Let's look at the cost of equity, and let's just have a little think about the cost of equity in this context, but also it would apply just as much to Spark Space. And I can jot things on my Word document in a way that I couldn't if it was just something blocking the space. Ultimately, the shareholders have a return from their investment in Spark Space or in whatever this company was last November, in one of two ways, or a combination of two ways. So if I say, where does the return earned by shareholders come from? Can you? I've given you a clue that there are two ways. How is it that dividend payments and appreciation of the share price? Brilliant. So this applies so often. So I've copied Gavin's answer, just typed it in there. Yes, the annual dividend payments and the capital value of their investments in the appreciation of the share price. So they're the two key elements that the shareholders benefit from when they are investing in any company. Now, down here, I've now got some key points. The cost of equity would generally be higher than debt, irrespective of what the unseen in that exam said, we would tend to have to pay more in terms of a return to the equity holders than we do to anybody who's provided us with debt finance. And they risk losing their investment. So they hand over their money, they buy the shares in the company, they may buy them from the company at an initial offering, or it may be that they buy them when they buy them from another shareholder who is selling. But whatever happens, they can lose their money. In the UK, I've already made reference, I think, to British Home Stores in a previous class. British Home Stores, BHS, has recently gone into administration, and those people who had shares in the company can expect to lose the value of their investment. So when there is a risk that the investor could lose their investment, you would expect that particular investor to be able to earn a higher return than another investor who didn't have as much of a risk of losing their investment. So the higher the risk, the higher the return, and the equity shareholder is a higher risk, so they can expect to have a higher return. And as the unseen said, they don't have to be paid a dividend. So there could be an element of uncertainty. I think from a sensible financial perspective, the dividend policy will often be fairly consistent from one year to the next. Even if the profitability that underpins the dividend may have been a bit up and down, they will try and maintain the dividend because of the expectations of their shareholders. But I think the other thing that's worth me mentioning, and you can tell me that you've done all of this before, and then I will just rush along a bit more, but I'm assuming that this is helpful. There are two types of investor very often. You've got the investor who is investing for income. I think you get a lot of this in the States, where people will have bought shares in companies in order to have the income to be able to live off. Particularly retired people may well have bought a clutch of shares so that they get their dividends, and then they can use that for their living. And so when you've got that kind of an investor, you want to continue to give them their dividend year after year. Certainly that would apply to insurance companies and pension funds. Very often they want to invest in companies which will pay out dividends, because then they can use it in order to pay out, in the case of an insurance company, they'd be paying out the insurance costs of claimants, and pensions, well, they will be paid to the pensioners. So some investors particularly want to have a lot of a high level of dividend payout, and they will want to try and maintain that. Others may be in a higher tax bracket. Certainly in the UK, there's more than one tax bracket, and people on high income tend to pay a higher rate of tax. So if they were to earn dividends, they would have to pay the higher rate of tax on those dividends. So they would generally want to have a company that has a low or nil dividend policy, so that the value of their investment grows, and that's capital growth. And that was what Gavin was referring to when he gave me the answer to the previous question. And in those kinds of circumstances, any investors who want the cash would sell their shares, and typically the tax rate on a capital gain may be lower than the tax rate on the income earned from dividends. It's just the tax implications. I can quite well imagine that if you're watching from Dubai, then the tax arrangements are completely different. But you've got to bear in mind that our examiner is based in Scotland and will be using the UK tax system in the back of their mind, even if it's not a completely conscious thing. Okay, I've got a couple of questions that have cropped up, so I will digress. Is it worth giving dividends if there are already investment opportunities? If they are available, even if the company has regular dividend payment record? Ziad. That kind of question is probably more likely to come up at strategic level. But the answer would be probably yes, because you would want to try and keep the shareholders satisfied. If your investment opportunities are generating a return which is greater than the cost of capital, then you'd be looking to finance them with debt rather than with equity. But you are probably alluding to the point that there will invariably be some transaction costs in arranging the debt to finance an investment opportunity, which would effectively make it slightly more expensive. But on the whole, because of a couple of factors, one of them is called the signalling effect, and the expectations of the shareholders, it's probably better to try and keep the dividends at a consistent level for that reason, to try to discourage them from, so that they're not encouraged to sell their shares. I hope that makes sense. I think we need to know about how we value the cost of equity. I talked to a lot of people, and I was surprised to see quite a lot of training providers setting questions which involved extensive calculations, because CIMA themselves have said not to expect that. It may be that within your exam there's the odd sum that you need to do, but I wouldn't expect very many. But this one here I think's well worth me just going over for a few minutes. The value of the share price, and bear in mind that we are an unquoted company, so there's no listing which shows the share price, but you can work out a value for the company based on the dividends and the return or the cost of equity and the growth rate. So, and by growth rate I mean the rate at which the dividends are growing. Now for us, we don't have a long series of years that we can use to draw this out, but we may get something in an unseen, and if so, it may well indicate what the value of the company is. the moment the value of the company can be identified, I suppose, using the book values, but we would normally be very reluctant to rely on book values for too much in terms of that kind of thing. And you can rearrange that formula, and I'm sure you must have done this for your F2 exams, by identifying what you consider to be the dividend next year. Typically, it's the dividend this year with the growth rate for 1 year added onto it, and then you would divide it by the current value, assuming that you know the current value, and then add on a growth rate, and that would tell you what the cost of equity is. The KE is the cost of equity. We have an interesting scenario. We don't know an enormous amount, but a couple of things. Maybe if I shrink that back. If I do a new slide and I just values from the unseen, we know that the retained earnings were 1,025. They're now which means that they've gone up by 136. So that's useful because that enables us to know how much the dividend was, and the dividend for the year, the profit for the year yeah, I'll come back to that in a minute. Was 912. So the dividend paid was thank you so much. 776. I've got a few copies of these, and I think I must have done this on another one, but and that's in W dollars, and that's in million. So it gives you an idea of what sort of dividend they're paying out. They're paying out a very large proportion of the profit as a dividend. Let me go back now. If we're not quoted, how can we find WACC considering we don't pay dividend? Well, I think the second half of the sentence we've disputed, and Gavin has very kindly worked it out for us, and I rather more slowly got there. But yes, no, we've definitely paid a dividend. And that was we can't necessarily work out a WACC. We would need more detail. We don't really know the market capitalisation. We've got a book value, but we haven't got a market value. The market value is what someone is prepared to pay. I'm sorry, it's as clear as that. and certainly in the UK, on the London Stock Exchange, then the value of shares go up and down on a day-by-day basis, but effectively the daily price of a share times the number of shares in issue constitutes the market value, the market capitalization of that particular company. But I wanted to show that at least we know a little bit about SparkSpace. I said a minute ago that we could work out various things so long as we had that information, and in the event that you were asked to put a valuation on the company, you might be asked, well, what information do you need? Well, if I go back to that slide that we looked at there, rather than a share price valuation, we could have a total company valuation if we were able to divide the 776 million, which is the total dividend. This formula that's in front of you is written primarily for a single share, but you could have the total dividend. In fact, why don't I copy it so it's unambiguous. Copy. And I can say company value equals the total dividend, which is our 776 million, divided by the return minus the growth rate. And given that we've got this in this manner, there you are. So I've done a little fraction there. I don't think I have a paragraph. Oh, I do have a paragraph. Yeah, so the company value is the return being the cost of equity minus the growth rate at the bottom of the fraction, total dividend at the top of the fraction, and that would give us a market value for SparkSpace. As you know, you have to combine different costs, your cost of equity and your cost of debt, in order to be able to derive the WACC. Whether they'll because I'm not expecting them to give you a lot of calculations, I'm not expecting them to ask you to do that, but they might expect you to be able to explain what's going on, or what information would you need in order to do it. So hopefully this is a useful little formula here, and if you were able to recall the 776 million, then it could be that you're able to put that in and use it quite usefully. Right, so let me move on, and the second part of the cost of the funding cost is the cost of debt. And here we have to recognise that debt could be secured. Well, if it was secured debt, we've got the potential to do that, then that secured debt would be against specific assets. Now, we've got fairly substantial, nearly a billion, isn't it? Nearly 1,000 million in terms of property, plant, equipment. So it is possible to identify particular assets that could be used to secure loans, provided, of course, that they've not already been used to secure other loans. And if the examiner wants you to demonstrate your understanding, then you have to show that in the event of the company becoming in liquidation, then what would happen to the secured creditors is that that particular asset would be sold off in order to pay off those creditors. And because those creditors have got that little bit of security, that little bit of extra reassurance that in the event that the company does go into liquidation, then they've got more chance of being repaid their investments, they would typically earn a lower rate of interest. So if we're able to raise debt against a secured, we're able to raise secured debt, we typically pay a lower interest rate than we would do if we were raising debt on an unsecured basis. Unsecured debt, I think I've managed to put an extra R in it, my apologies. Unsecured debt simply means that in the event of us becoming in liquidation, then the creditor would have to line up in the queue along with all the other people that we owe and take whatever share of their investment that they get. So we typically pay unsecured creditors a higher rate of interest. Now, within our syllabus area that we looked at a few minutes ago, we saw this reference to bonds and to convertible bonds. So here I've returned to that. There's a lot of words that are used that are interchangeable. You might come across the expression loan stock, or debt, or long-term loans, or bonds, and really in most respects they all mean the same thing. They are all debt finance. They're all borrowed money that we're using in order to finance the company. So when I talk about secured and unsecured debt, they are types of bonds, and typically these are bonds which would carry a twice annual interest payment, and then we would settle them at the end of the period. So typically a 5-year bond, at the end of the 5th year we would repay the initial investment as well. There's flexibility in there. Sometimes you get bonds where we don't have to pay interest on an annual basis, but we do pay additional interest at the end of the 5-year period. And there are several other varieties based on the general theme, but all of them we can work out, and any investor can work out using something similar to the internal rate of return calculation. Yes, I just had a quick look to see whether I would be doing too much if I just sort of went off for a moment and just added an extra slide. Effectively, the So you've got the various cash flows. You've got the initial cash flow, and then you've got the annual interest payments, and you have the redemption payments at the end. And by using the market return, typically it's the percentage interest rate, we can find the return on a particular bond. And so that method tends to work quite well. As you can see, I'm talking about it from the internal rate of return point of view, so it does mean that what you can do is if you repeat the exercise, you can do a interpolation and find the exact rate that the bond is earning. And this is very often looked at from a yield. Maybe I'll do a new slide. But yield to maturity is the percentage rate earned by a bond, and that has a specific mention within the syllabus. I think we need to look at one other aspect of bond finance or loan finance, and slightly smaller. So loan finance has a tax benefit. Let me show you the statement of financial profit or loss, and you can see in here, let me enlarge it a little bit. No. Plus is for enlarging. You can see in here that effectively Sparkspace saves money. That might sound odd, but if I type this in next to it, it might make sense. Comments. Okay, so here 247 is the cost of finance, but this brings the profit before tax down to 1,249. And because it's brought the profit before tax down, the tax payable is lower. To try and help, if I show you that the tax expense represents about 27% of the profit, then if we paid tax on the operating profit, we would pay, well, it's 26.98% of 1496. So we would be paying about 404 it saves about 67. And that's a big advantage that the debt finance has over equity finance. That it's cheaper, and part of the reason is the, I'll put it in inverted commas, tax shield it generates. So the profit is actually higher because the tax is lower. Does that make sense? So the loan finance has a tax benefit. And for those of you who will want this as a I will try. Okay, so I've taken that, I'll put that into the slide just so that you've got the example if you look at this again. Please try to be over ambitious. I'm just going to close the chat box for a moment just to try and find it. Right, okay, I'll open the chat box again now. Okay. I hope that was helpful. So quick look at participants as well, see if that is. So that hopefully helps us with this whole area of funding. Okay, let's just go back to funding. Why am I getting these? Get rid of the notes. Okay. So, whiz through this very quickly. Okay, so back up to this. We have characters to ordinary preference shares and different types of long-term debt. The stock and the bond markets. I said I would talk very briefly about the role of advisors. We've done the cost of equity. We've talked about the post-tax cost of debt, although I didn't specifically refer to bank borrowings, but bank borrowings fall into that same category. They are not traded, so whereas bonds would be traded, the post-tax cost of bank borrowings is a non-traded item, so it would stick at the same cost of debt. But I will now talk about the point that was on here, which was the convertible bonds. Convertible bonds are bonds where the bondholder has the right to convert their bonds into equity shares on a particular date. So very often we're able to pay convertible bondholders a lower rate of interest. Lower than the market rate of interest, and the reason for that is that they are in effect taking a little bit of a gamble. When they buy their bonds, they are hoping that the right to buy the shares will effectively mean that they have a right to buy the shares at a lower price than they are trading at on that particular day, and thereby make an additional profit in addition to their dividends. In addition to the interest that they receive on their bonds. Whereas someone who's bought a regular bond doesn't have that right, so they tend to have a higher percentage interest rate. And the other area of bank borrowing is covenants. Covenants are conditions written into an agreement by the bank to allow you to borrow some money. The most fundamental is the agreement of what dates you make your repayments on and what dates you pay your interest on, and the amount of money that you borrow. And as a contract, you must keep up all your commitments in that respect. But the idea of covenants is that you have additional restrictions. So it may be that when you're borrowing money from a bank, it sets a covenant that your gearing ratio mustn't go over 80%, and then they would define what they mean by gearing. And that then, as a covenant, is a way of saying that if you were to breach that, you would have breached the contract and you could be asked to repay the loan all at once. Right. So we have now got just over 10 minutes of the class remaining. Do you feel more knowledgeable about funding now? So do you feel more knowledgeable about funding now? Would you be able to tackle a question? I know that I said a question last Wednesday and didn't get a chance really to go through it, because if you'd done it, I hadn't been sent it. Oh, Ziad, thank you. Any questions, anybody? Any? In the whole world of exam preparation and so on, you've always got to put the facts into the melting pot. And the fact that this particular topic, this F2 A1 topic, hasn't been tested since November of last year. I'll come back to Ziad's question in a minute. Means that I think this is well worth making sure that you understand. Right, let me go back to Ziad's question. I have to start off with, I'm not expecting your examiner to ask you to do any calculations at all. And I'm going to continue by saying the use of a proxy company, which is basically what your question is looking at. Again, that isn't really an F2 topic. Yes, the CIMA does have that within its syllabus, but it doesn't have it on the F2. Can we take the rate of relevant quoted company? You could do, but I wouldn't want to spend a lot of time revising that. I think that's more likely to be tested on an F3 OT exam, and perhaps referred to on a strategic case study. But no, I think there's a danger of overcomplicating the topic. Our syllabus doesn't go quite that far, so you might have to be able to discuss types and sources of long-term finance and their appropriateness for an incorporated company, and certainly this is an incorporated company. I think it's probably not on it's not listed on a stock market, so I think in that respect it's quite similar to the one that I was showing you from November, I think that there may well be a question that comes up about what do we do if we need to try and sell the shares. What sort of information would we require? But I'm not expecting one that would then go on and say, having got that information, how would we then calculate it? I'm not expecting a calculation at all. So there may well be a little bit of disappointment, I suppose, if you're an expert on proxy companies and ungearing and regearing, but we don't do any of that. We don't have any of that to worry about. We are simply looking at the various sources of long-term finance, the bonds, we're looking at the bank borrowing, looking at the types of bonds, we've got the recognition of the yield to maturity, and the fact that that will then identify the return that any prospective investors will receive. And then we've also got the other one, which was to do with the convertible debt, where the investors will typically accept a lower rate in return for the right to turn those bonds into equity, should they so wish, at the end of the term. Any further questions? We're now into the last 5 minutes. I could well imagine some of you may well be getting a bit tired. And I suppose the other thing is, any requests in terms of topic areas for Wednesday? So we're 5 more minutes. So if you've got any particular requests that you'd like me to perhaps do some example questions with you on Wednesday, then now is the time. Otherwise, I'll simply go back and go through some of the areas that I think are fairly likely to be examined in one or other. Products and pricing. Okay. Better write that down. I'm going to make a note of products and pricing and then come back to Alan's question. If asked, what is the suggested debt to equity ratio for prospective investment opportunities? Alan, because both Sparkspace and BitBunch have very similar gearing ratios, and fair enough, you've made reference to debt to equity, but whether it's debt to total capital invested or debt to equity, they're going to be very similar from one company to another. It may be that is the going rate for this industry in Breesland. I don't think that there would be a benchmark that we would be working to. I think that the unseen could set a benchmark, but they would be setting it in relation to a bank covenant. So I don't think it would be helpful to work out a sort of a target debt to equity ratio. One of the things that we've spotted here is that they've got a very good interest cover, so it means that they're making good profits even though they've got quite a lot of finance cost, and that the finance cost is a lower percentage than the return that they're getting from the money that they're borrowing. So they're borrowing at 8%, but they're earning put that on here. Well, their operating profit is around about 35%. So they can afford to pay the 8% out of that. All right. So I hope you've had a So I hope that, oh, hang on, I've got a little question that I've missed. Out of the subject, I can't connect the income statement and the amortization of intangibles. Oh, okay, let me have a look at that then quickly. The income statement with the amortization of intangibles and the gain and loss on the sale of PPE. Right, well, the income statement would subsume the amortization of intangibles and the gain or loss on the sale of PPE within the cost of sales. A quick look. We've got a change in the value of intangibles where it's gone from 674 to 927, made up of additions of 550 and a charge for the year of 297. The 297 would have been incorporated within the 2,700 cost of sales. And what was the other one? The gain and loss and sale of the PPE. Right, they've got a disposal worth 240 at cost. The disposal had been, let me do it quickly. So it's 240's gone out. It had already been depreciated by 95, so it's worth 145 was the book value, and we don't know, unless I've missed it, the cash received that would enable us to work out the gain or loss. But obviously if we received 150 we would have a gain of 5. If we'd received 140, we would have a loss on disposal of 5. All of this would be incorporated within the cost of sales, so it wouldn't be shown separately. Can you try to check? Yes, it would be appropriate to put the amortization of intangibles to cost of sales, because there are two types of intangibles. One of them is a patent. The patent is there to enable us to produce the products that we ultimately sell, and the other one is development cost. So both those intangible assets would be amortized into cost of sales. I know you've said, can you try to check, even not now, but there's no further information that would enable the cross-checking. I could try and find you a breakdown of costs for another scenario. If I can, I'll try and send you an email with that, Alan. Everybody happy? All right. Thank you all very much, and I will now stop sharing my screen, and then I will save the recording, and then we can upload that so that those people who weren't able to watch it at the moment would be able to watch it another time, and if you wish, you'd then be able to watch it a second time and speed up the bits where you think I'm sort of rabbiting on a bit, and slow down the bits where you think it's more useful. Okay. So thank you all very much, and I missed off the H. Thank you all, and good night.